Good morning, ladies and gentlemen. Well, the risk dial closed at 60 for the week, which is probably one of the best scores. We went basically from the 50s to the mid 60s. Uh, this is something that it indicates that the danger of a complete fall apart in the market is quite remote as far as the spreads are concerned. But this is not something that I will take very seriously at the moment, because I have some other spreads which I want to show you, which actually could potentially move a long way, which would indicate that the market as a whole is going to remain pretty stable, but that the internals inside the market, inside the SPX, could go all over the place. So what I want to do this week is actually go through what I see first, and then give you my predictions as to why it's likely to happen, and quite what potentially the targets might be. All week I've been saying that a steepening yield curve is a much better position to have than a long equities one. And I think from this chart of 2s10s, it's undeniable that the yield curve has a steepening tendency. 2s10s is going to be not the place where you really see it, because we all know that the Fed is not going to move rates for a very, very long time. So 2s10s are unlikely to be the place where you see anything more than a few basis points, but it's undeniable that the trend is back towards these levels that we saw. And don't forget, we never really saw a close much above 63 to 65 area. So we are getting there. I know that we got into the 70s because I sold them up there, but we are definitely steepening even in the 2s10s, which is the part of the curve which is going to see the least steepening tendency. 3 months to 5 years as dead as a doornail, and so it should remain. I mean, the Fed has got that totally under control. 5s10s, as you can see, much like the 2s10s, within a couple of basis points, but the trend is there. Now, where you will see the steepening really is in the 5s30s, and it's undeniable now, I think, that if we start breaking next week this 123 level that we traded sometime a couple of weeks ago, we are probably going all the way down to 140, and these levels where we traded basically throughout the whole of 2015 out to 2017. That will still be a very contained move, and I'll be very happy if it stops there. If it starts going through 154 at any stage over the course of the next several weeks, something very bad is going to happen to the risk markets. But one step at a time. I think the first real target is to break next week this 123 level, and which will be quite an achievement, because that's 4 or 5 basis points on top of what we've already done. That's going to be quite difficult in itself, but that gives us without a doubt a target at around 140. Now, this is the chart that I pointed out to you, and this is a differential between bunds and 10-year notes, and this is now getting to it got to my target, and it's now potentially panic stations. So the probability of a Democrat clean sweep has increased, and therefore this spread has gone out. This is probably one of the safest ways to play the election, because the moves on the downside are going to be contained, but to the upside they could be quite explosive. So it gives you the most risk reward. You can see that now if we start breaking this 124, 125 level, there's nothing really until the 150s. That is a big move. That's 25 basis points in a market which basically moves 2-3 basis points per week. What to say about this? Now, I'm out. I've made my 5-6 basis points and I'm happy. But I recognize the increased probability that this is going to break. If it breaks, as I said, it's going to be quite dramatic. This cannot be good for any sector of the risk market which is interest rate dependent. And so I'm basically putting it out there, and in a moment we shall look at what those spreads are saying and actually how much they might move. It's really quite worrisome. Well, the dollar continues to reward no one. It can't get to my level where I want to short it, and I'm not going to play it while it's doing this. I'm just not. Now, the previous chart that I showed you of bunds against 10-year notes implies that the differential has potential to move out further. If we are at where we're going to stop, which is what I think the central banks are going to try to do, around this 125 area, then that has absolutely no impact on the dollar. But if it starts going out to 150, the dollar should strengthen. Okay, and we should get some sort of an ABC back up towards the 96s, and those targets that I have to short it, which is around the 155.50 against Euro USD. So nothing has changed there, but I will just not play it while it's doing this. I think it's the risk reward is just too low. It's evens or slightly better than evens, and those are odds that I don't take. Although I recognize that everyone is saying that a Biden victory or a Democrat clean sweep is going to get the dollar lower, I'm not so convinced. I'm not going to argue that it's going to make the dollar stronger, but I'm just not so convinced that it's going to make it that much weaker. And therefore, I don't want to play it. I think playing it in interest rates via steepeners or via the spread between bunds and 10-year notes is a much better way, much safer way to play it than to risk money in the DXY, which has been non-trending and basically giving everyone, including myself, a headache over the past 2 or 3 years. Gold has basically been stuck between a steepening yield curve, implying higher long-term real interest rates, and a weaker dollar, and has basically been going around in a inside week as a result of those two factors. I think the likelihood of seeing a panic move up in gold because of the election is not that great, and it will be a short-term move simply because I just don't think there is a reason to panic if Joe Biden gets in or if Trump gets in. They're both known quantities, and I don't see that precious metals should react in any way to a normal election. They might react with a bit of a spike on a contested election and other kind of problems that would cause within the United States. But at the moment, I think the odds of that happening are pretty low. So what do I see at the moment in gold? Not a lot. Basically, I think this level that I recommended to you around 1855, 1860 is pretty solid, and really the chances of us breaking much higher than 1958, 59, 60, where these previous highs are in the next week, are probably quite small. So trading range between the 1850s, 1860s and the 1950s, 1960s. That's really the result of being trapped, as I said, between a steepening yield curve and a slightly weaker dollar. But these spreads are what I want to talk to you about today. This is XLF, XLK, XLV, XLK, XLI, XLK. Here we have the Qs against the SPY, the NDX against the SPY, and the Qs against the IWM. Now, these spreads have come an awful long way. I mean, just incredible. These are daily charts. And to give you an idea, this is, let's pick XLV over XLK. This line here goes all the way back to the worst levels that we had back when God was a boy in 2011. I think you will see that all of these charts have been in very well-defined downtrends for such a long period of time. You look at how far we've come. This is like from the 40s into in the low 20s. That is that's a huge move. That's a doubling of the XLK over the XLF over that period. This is a 25% move, just that you can see here in a year. And XLI, XLK, much the same kind of thing, from 115 down to 67. I mean, you can see that, we have moved an awful long way. Given that, let's put things into context. We now have a steepening yield curve, while throughout this period we've had a flattening yield curve. The dollar is not really a factor at the moment as yet. And, the COVID thing has exacerbated all the high-tech trends. Now, I'm not saying that the high-tech trend is over forever, but what I'm saying is that, if it's a Democrat sweep, the odds of tax harvesting before year end are very, very high. People are going to be wanting to sell their winners and basically book the tax gains now as opposed to later, when they fear that their tax rates might have gone up. If that happens, we have a long way for these to retrace. Let's pick the most obvious one, which I would have thought is NDX over SPY, right? I mean, let's look at it. Look how much it has, gone up from in a year. In a year, it's gone from 25 up to 35. That is a humongous move for something that should be relatively stable and slowly trending up. Could we have a retracement down to the 0.382? Absolutely. If we break this level, which is 32.71, that will be the tendency back to this moving average and the 0.382, which is 31. Well, from 33 to 31, it's just less than 10%. Okay, so that is a 10% move over the course of the next few weeks in NDX SPY, enough to make you a year. Here against the Russell, and you can see this better here, the odds of touching this line again, I would have thought are pretty good. I mean, we were there in April and May, so it's not a huge thing to expect. And just before big potential volatility, all these markets tend to revert to mean and go back to their longer term moving average. Now, that is a move from, the 180 down to 160. That's, again, very close to a 10% move. If we have a look at the Qs, which are probably the most aggressive against the SPY, I would not be surprised to see a test and a break of this level, which is 0.8, and a move back down to 0.76, somewhat close to this moving average. That's another, double-digit move. So this is the danger. The danger here is that these spreads revert to mean and that we have a very big move in the tech sector. And another chart which makes me pretty certain that we're going to have an accident in tech between now and the election is this. This is the VIX, so the S&P volatility against the volatility of the Nasdaq. You can see how they are actually set up quite differently. These weekly Bollinger Bands are now beginning to go out. So I think over the course of the next 2 or 3 weeks, we are likely to revisit this 47 area, while in the VIX, I really think around the 35 to 37 area is all you're going to see. Now, is this a huge thing for the difference between the Nasdaq and the SPX? You can argue with me. I don't know, but I think you are definitely going to see several percentage point moves differential between the SPX, the volatility of the SPX, and the Nasdaq. Unfortunately, until the Nasdaq contracts come into being, you can't play the differential, because the ideal position to me would be to be short of VIX volatility and long of Nasdaq volatility at the moment. Unfortunately, I can't do that, and therefore, I have to play the indices straight. I will have a look in a moment where those levels are that are interesting to play the differential between SPX and Nasdaq. But to me, this chart tells me that I'm right, that there's going to be a little bit of continuation, at least, of the move we saw on Friday, which was basically a risk-off move in tech and hugging the broader indices. So money is going out of the high beta stocks, and it's going to hug the index, dampening the volatility in the S&P 500 and heightening the volatility in the Nasdaq.
And lastly, the thing that makes me quite certain that we're going to see some Nasdaq or high tech weakness relative to SPY is the setup in the deviations. I think the odds of seeing much lower than 3200 in the SPX are very low, while we have sectors which are not huge, but are actually telling us that we are not going to have a lot of downside in SPX. We have a setup in XLK which could come all the way down through the previous lows. So if you have a look at XLK, you can, please download this file every day. You can see how much room we have on the downside before we get to the green. Well, if we go up to the SPY, we can see that really it's unlikely to break the previous low. And that to me tells me that the 3200 area in SPY is going to be very difficult to break, while the Nasdaq could have a bit of a mare next week.
Okay, so let's have a look at the relevant levels in each contract to see where we might put on some interesting spreads. Now, from a weekly perspective, I think we now have very, very good support around 32.10 in the SPX. If we see that, that will be a great place to be long, I think. I don't think it's going to happen next week. I think the volatility in the S&P is going to be much smaller than the volatility in the Nasdaq. So, 32, 10, 15, whatever in the SPX, I think it's going to be very, very hard to break. From a daily perspective, we, much the same here. The moving at the Bollinger Bands are down around the 32.45. It's going to be very tough to break. I mean, if you ever look at what we did last week, 1, 2, 3, 4, 5 days of it and sustained a gap up. And we know that level 32.18, don't we? So basically, it to me, this says this market is not ready for any great dump.
it's going to be a trading market, and really this chart tells it all. Only a close, on below 33.28, which is 33.18 in the ES, is going to have any kind of follow through on the downside, and then it goes to 32.71 on the SPX, which is 32.61 in the ES. Always have, remember that 10 basis point, 10 tick basis. What does this chart tell me? It tells me not to really get bearish of the S&P at all, really, while it's trading above 33.28. The fact that we couldn't break and go into the gap all week actually tells me that I'm right in my view that people will be buying every dip to hug the index, and that basically there is very little to do in the SPX apart from spread it against the Nasdaq if one is bearish. And I think the Nasdaq is quite technically beautifully poised for a bit of a dump, relative to SPX. If we actually have a look at the 195-minute chart, we can actually see that we could be forming a nice little ABC. It got to last week exactly to where I thought it would get to, this 11,500 odd, and backed off quite strongly, but this was only the beginning of the move. As you can see now, we could touch this 10,750 area in a hurry. Monday, Tuesday, it could be a 2-day event down to the 200 period moving average. Why not? And probably, we could even reach these kinds of levels around around 10,000 or below 10,000. If tax harvesting comes through, I think, over the course of the next month or so, the Nasdaq is going to continue to be under pressure, not because they're bad stocks, but because people are selling them. The weekly, it got to right where it should have done, exceeded by a few ticks smack. Now, if we start opening below and trading below 11,058, I think without a doubt we touch the lows previously, which is 10,650, and most probably we touch this area here, which is around 10,300, 10,140. I think that could happen next week. I think next week we could trade all the way down to 10,300 or so. On the daily, first support is going to be 10,800, and then we could have a couple of ugly days outside of this while we do some kind of an ABC. I really would not think that is extreme. 200-day moving average coming up, so in 3 weeks' time that we've traded down to 10,000, why not? I think all these markets are likely to mean revert over the course of the next few weeks, and as they mean revert and people hug the index, the most vulnerable index is the one that everyone owns and everyone is overweight, and that is Nasdaq. And lastly, I'd like to have a word with you about EEM, because it's one of the sectors that's drawing my attention, because it could be interesting for the very simple reason that people need to diversify. The trend of long the US, short everything else, I think is coming to the end at the moment, ahead of this potential trouble in the US. Not that I don't think it's going to come back at some stage. In fact, I'm convinced it will. But I think in the shorter term, the medium term, it's probably going away. in which case the money is going to flow, or a good portion of that money is going to flow into EM. I still think that this area around the 42, and if we have a little bit of a panic down to 41.50, is a very good long-term buy. I think at some stage we will see it through 45, go up to 52 and make new highs without any doubt. So this area around the 41 to 42, if you have some money that you want to put away for the medium term, I think this is going to be a very, very good risk reward play around between 41.40 and 42.40. Okay, so here we have the summary for this week and what I told you last week. Really no change in the 2s 10s or the 5s 30s. I still think the yield curve is steepening. 105 is still your stop loss. My God, what is going on? But I think this 140 level is is attainable. A break of 120 to 123 is what signals the intent to 140. DXY, I mean, just leave it alone for the time being. Clarity will prevail at some stage. That stage is not now. So I've left, nothing much there. All I've changed in gold is I say that I don't think it breaks the 1860s unless the dollar does something huge. But I don't see a lot of upside because the steepening yield curve is not good for gold. These are rising real interest rates, and therefore I would leave it alone. I doubt that unless the dollar does something stupid, it can break 1860, but no way does it break the 1960s, not before not before we have some dollar direction. SPX and NQ, I think, is where the action is going to be next week. It's very clear that 33.28 is critical. Okay, now that is very, very clear. Below that, bad things happen. While it's above, we have chances of rallies up to 33.90, but I think it's all going to be squeezes on the back of a bounce in NQ from an oversold level. I think it's very unlikely that we have a strong week, and we need to look above. I think it's far more likely that we have a pretty bad week relatively, but much worse in NQ. We could have a stable whippy week in SPX and a weak week in NQ. To me, I still think that before the election you see this 10,200 to 400 area, but the first bounce is going to be off 11,800 support, daily support. I told you last week 11,530 to 50 is very good risk reward on the short side, and so it proved to be. I don't see it happening this week. I really don't. I think it's going to be a very weak week for Nasdaq. But if it's not, and I'm wrong, and those volatility comparison charts are wrong, I guess again 11,530.50, and only if it closed above could I possibly even start thinking that Nasdaq has regained leadership. I think that is so unlikely, I just can't see it. EM, I've changed nothing, but this 41.40 to 42 area, if seen, I think is going to be a wonderful long-term or medium-term place to get some EM for well after the election. I think it's going to be a strong period this last quarter for EM relative to the US. Thank you very much indeed, and tweet you on Monday.